Check my speaker. All right, guys, today we're going to go over underwriting, doing a cash flow analysis, evaluation of a property. This is important because this is exactly how you're going to show how sellers need to list their property. How do you get to the evaluation on the price point, right? Where do you take it out to market? A lot of people might think, oh, it's going for 50,000 a door or 80,000 a door. And they just might think that's across the board, just any property, it's a per door. And that's not the case in commercial real estate, right? It's dependent upon the cash flow, right? This is not single family homes. This is not residential where you just do a comparative market analysis and say, oh, across the street, X, per square foot. It doesn't work that way. So it's imperative that you understand how to come up with these evaluations, or you're essentially not going to have any listings, any business, and it's going to be tough for you to talk to sellers and even potential buyers that want a certain cap rate or a certain metric or certain return. So obviously there's internal rate of returns. There's cash on cash metrics. There's so many other little metrics that some investors or purchasers or sellers measure. But the main metric that you will hear the most is capitalization rate, right? That is the net operating income divided by the purchase price, okay? And the way you get the net operating income is you collect all of the expense income, right? You find out all the income and you subtract all the expenses, and that leaves you with the net operating income. So for example, right here, this is a trailing 12 month. And when you underwrite these properties, you want the most recent 12 months. You might be asked for the last 3 years. You might, have other requests for different items, but the trailing 12 months is what you're going to want to go off of. That's the most recent, obviously. And here it is. So as I mentioned, the income, this could be laundry income, right? This could be pet collections. Maybe there's pet rent you hear sometimes. And obviously the gross rental income. What are they collecting each month? So that is all of your income. There could be others. If you charge application fees, just all the income that the asset takes. Okay, so that goes in the first line item for your income. Okay, then you get your totals and you come up with your gross profit. So the expenses, a lot of times you'll see brokers or not so savvy, even owners. Sometimes owners don't even realize what goes into expenses. I mean, it's sometimes you'll see some evaluations that are absolutely crazy, and they don't put in even their taxes. They forget to put the management fee. They don't say what their insurances are. Their repairs and maintenance are usually really, really light, and they don't count into, oh, I forgot that broke, and they didn't put that in the line item. So to get a true underwriting and a true number, you got to collect every single little expense, right? From landscaping to, pest control. So office supplies, right? Maybe your bank charges like this one right here. Maybe there's bank service charge. So you got to understand the utility. So that's one thing, guys. Also, a little side note, RUBS, write this down. RUBS, RUBS, RUBS. That stands for Ratio Utility Billing System, okay? Or Resident Utility Billing System. It's a way to be reimbursed from the tenants for the utilities that you spend. So in this particular apartment building, the owner pays all the utilities, the water. Well, they do pay electric. The tenants do, but he pays all their water bills. Okay, so you hear sometimes like, oh, are they separately metered? Well, that's a huge value add because look how much at the end of the year this one's $20,000 of water utilities. That's a big number, right? So if you're the owner and you're paying that for your tenants, and you can bill them back, whether that's separately metering, so each one, or oftentimes you'll have one meter and you don't want to put 30 grand into expense to separately meter each unit. You just do a ratio, like, okay, there's 15 units, we're just going to give them a flat fee of $45 a month or whatever, right? So there's just ways of reimbursing yourself. So little side note, that's RUBS. You'll hear that term. So once you get all of your income, you subtract all your expenses, okay? And that leaves you right here in yellow, your net operating income, your NOI. All right, so net operating income. That's another acronym you'll see, NOI on, and that's an important figure because inversely from as we mentioned, the NOI divided by the purchase price, if you're trying to come up with an evaluation for a seller and you don't have a price point yet, but you know what the market cap rate is. So for instance, a 7 cap, you hear that, right? Oh, I'm looking for a 10 cap. Everybody wants a 10 cap. It's not there with apartments in decent areas, right? The higher the cap rate, traditionally more risk is involved, right? There's more risk, there's higher rewards. You hear that? Well, it's the same thing. That's why some mobile home parks, different things have higher cap rates or in bad neighborhoods because there's a lot of risk associated with that, right? You're in a bad neighborhood. Well, do you want to be walking around with a bulletproof vest on? So you may get higher returns, but you may not get your rent collected. So there's risk associated. So back to the cap rate. If you don't have the evaluation and you know that the net operating income in this case is $81,000, okay? The way you would get your evaluation is you would take $81,000, the net operating income, and you would divide that by whatever the going cap rate is. So if there's a similar asset that is a 7 cap, and that's kind of the standard for a nicer area, that many units, etc., you divide it by that number. So for this example, 81,000 divided by a 0.07, that's a 7% cap rate. It would put out an evaluation around a 1.15, okay? So this is next to the beach. It's a little bit nicer market. So we priced this closer to about a 6 cap, which if you divide 81,000 divided by a 0.06, that gives you a 1.35 million evaluation. And we took this asset out to the market at a 1.3. So that's how we arrived at that number. But what I'm going to do, guys, is I'm going to plug these numbers. There's a deal check in the portal. I hope you guys have downloaded. It's really just plug and play. Once you get these from the sellers, these numbers, you literally can just plug in each line item and it'll spit out your evaluation. It'll just plug it in and you'll get your evaluation. So what I'm going to do is show you really well, I don't know how quickly it'll be, but it'll be relatively quickly. Let's see here. Okay. So let's just make sure. Okay. So we're going to do this. We're going to add a property. We're going to enter this manually. We're going to call this Silver Leaf Villas. Okay, guys, and you can get fancy with this and put all your description. You can do whatever you want. This one, 130, bought a fur. and this system is pretty nice because it it will geocode or hit on the map where your property is. So it'll put up a nice map. Property description. This is a multi-family. You can do land. You can do a single family. You can do commercial. I believe this was 1945. Just for time's sake, we'll just fill out the meat of this. But so the unit composition. It's always nice to do a breakdown on each. This is technically a residential unit. And let's just, for this, say that there's 15, because most of these are either efficiencies or one bedroom. So we're just going to do 15 1-1s. It is going to fluctuate. You can even put the rent roll in there, individually. You could put the rent roll in each one, but again, for time's sake, we're just going to do the gross collected rent. So income per unit per month, let's say per month. We'll put 81. This was a gross rental income of 160. Let's see, 163,000. 735. That was based off 15 units. Okay, so per month it was averaging about 909 per unit. And that's about right. I mean, market rents are about 850 to 1,000. So that's going to give you your rent roll, right? And again, you can break this down, make it as fancy as you want. But that's going to give you your gross rental. So the purchase price, in this case, 1.3 is what we are going to take it out at. I mean, that's what we've already kind of went over. I'm doing it a little bit backwards. So the financing terms, now this is going to dictate your cash on cash. We're not going to get on that topic too much today because it's just underwriting, but you need to learn what a cash on cash is. And if this was a complete cash deal, then the capitalization rate is going to be your cash on cash. But if you have a down payment of 20%, interest rates are a little lower. Let's call it 4.25. Your cash on cash means how much did you put down? How much were your costs getting into the deal? Okay, if it was $200,000, and at the end of the year there's a let's say it's $60,000 you net, and 250 was what got you in the deal. You're going to have a 24% cash on cash. Okay, and the way you get that is you divide the net, right? The net cash, the net operating income minus your debt service, okay? And you divide that by your initial investment. In this case, we just use 250. So again, we'll have another training on the cash on cash metric, but that's just a high level overview of what that metric is. But purchase cost, let's say 3%. You're gonna go to the next section. So here's your gross. Here was that gross rent per month that we plugged in earlier. We're going to put in a vacancy rate. This one was 14 out of 15 units filled. So actually that was being 100%. So if you're doing a pro forma, you always want to at least put a minimum of 5% in. 5% is how the banks would underwrite. So that's something good to write down if you're doing a pro forma that's realistic. Because if people are starting to look at your deals and all you have is zeros on vacancies and repairs, then they're not going to trust your deal, and then you got no shot. So I mean, in this case, this is the true number because this already factored in vacancies with the gross rent. But on a go-forward basis, on what you think, always put in a vacancy, whether that's 5, maybe it's 10, depending on the market. So operating expenses is the next line item. So right here, in apartment buildings, multifamily, the rule of thumb, if you're just trying to go off the fly, is 50% expense ratio, right? We've talked about this before. So like if there's $100,000 of, or in this case, there's 163,000 of rental income. A rule of thumb is 50% of that number would be the expenses. Okay. So if you're just, again, going on the fly, you could just say, okay, I want to find out if this is a deal. 163,000 expense ratio divided by 2. Okay. Now the net would be 81,000. Well, guess what? Going back to this, look at what the number really is. It truly is a 50% expense ratio. I think this was like 49 point something. So that's a good rule of thumb. It's not always that way. If it's poorly managed, you can have 60%, you know. Mobile home parks, they're a little bit lighter because typically you own the dirt and you're not having to have as many repairs and maintenance on roofs, you know, refrigerators, ACAs, etc. So for this little exercise, we will we're gonna actually plug in all the expenses, okay? And again, if you have this from the seller, you can just copy and paste it, okay, and make your own numbers, right? You can just itemize it per year, per rent. So just like this one property per year, the taxes were $10,997. Which again, on pro formas, guys, your taxes are always, don't make this mistake to not reassess your taxes, because some of these owners have owned it for 40 years and the taxes might be $5,000, and then you buy it for almost 5 times what he paid and it gets reassessed and the taxes quadruple. Okay, so another good rule of thumb is 1.5% of the purchase price. So don't forget to do that. That is a big mistake some people get into. They underwrite the deals, it's slim as it is, and then when they get hit with the reassessed taxes, they're underwater, right? Because they didn't factor that in. So, okay, property management fees was 17,000. We can change this to actually a set amount. So per year, boom, per building, property management, maintenance. So repairs and maintenance. And if you see repairs and maintenance, you should do about $250 per unit. That's another good rule of thumb. Repairs and maintenance was 20,000. This was per the year, set amount. Boom. Okay, capital expenditures. So capital expenditures, there was no HOA fees. Capital expenditures are, they call it CapEx, right? You'll hear CapEx. CapEx is like parking lots, okay? If it's an expense that you may not have to do every year, right? Like think about it, like a roof, you might have to do that every 10, 15 years. Painting, that's probably every 5 years, right? CapEx. So repairs and maintenance is stuff that it's gonna be every month, every 6 months, every year, you can count on it, right? Like, you know, broken doorknobs or broken AC or repair AC, or, you know, those are common repairs and maintenance that you're just going to have, right? People are in there rough on stuff, but capital expenditures is larger ticket items that are done every, you know, 5, 10 years, larger expenses. Like I said, parking lots, roof repairs, painting, you know, some of that nature. Maybe you're going to do a whole landscaping or gravel, whatever. So that's, there wasn't in this case. So we'll just actually take that out just for this little exercise. Utilities were 20,000. Oh, actually. So I put, this was utilities. I did a little typo. So the repairs and maintenance were actually 22,000. That's per year, not per month, or you'll get a really skewed number. So landscaping here, they had, I don't know if they, gardening maintenance they put in. So $1,000. See, that seems kind of light to me, but there wasn't a whole lot of maintenance there, right? There was, Botifer, they had a lot of just pavement. Just had a couple little strips of grass. So here it is, 93,000 per year. Okay, let's make sure we did this right. Per year, per year. Per year. Okay, per month. See, that was wrong. Now it's per year as well. See, boom, that changed it. That was 10 grand. See, that's a big mistake. $1,000 a month per $1,000 a year. That's a huge swing in your underwriting. So, okay, so we saved this. Let's go. And see, look, I didn't even plug a picture in. So look, here's a nice little building. There's actually two, let's see, property description. So let's just pop out the evaluation. See, so let's see what we got. Ports and sharing. We are going to view this just to see. Okay. Oh. Okay, so here we are. As we said earlier, about a 6 cap, we were saying the market was, and there we are, 1.3. So this tells you the cash needed to get into this deal is 299,000. That's with the 20% down. It was on 15 units. 1944. So here it gives you a little map, little mapping tool, shows you the little survey boundaries. And then, so here's your analysis. 1.3, you're financing $1 million, 260 is your down payment. Okay. The debt coverage ratio. So another metric banks are going to look at is a debt service coverage ratio. And I talked to a banker today. He said they're looking at 1.25 and up. What that means is they want 1.25 of the net operating income, 1.5 times, 1.25 times the net operating income. They want to make sure that your net income is covering 1.25 times the loan amount, debt service. Okay. So if that number's not at least at that, then you can expect to probably be underwater if you're financing it. So here's our analysis again. Say 49%, we're right there, 49.7. Remember the expense ratio, the operating expenses, we didn't shortcut it. We put line item, and they were good about giving all their expenses. They had bank service charges, they had licenses, they had pest control. We actually left a couple of those out, to be honest. I didn't plug those in. So I should really go back and plug those in. But it was right there. I think it was like 49.9 because those were only a couple $100. But don't leave anything out. And here it is. So again, gross rent 163. Your operating expenses 81,000. Okay, so your 163 less the 180 leaves you 182. All right, your loan payments, known as debt service, is 61,000. So your net free cash flow after all is said and done, property taxes, insurance, management, and your loan to the bank, you're going to be getting $21,000 to take to your bank, right? Or you can put it back in the property to upgrade, do different things, whatever, but that's your cash. Okay, so this also has a nice little buy and hold projections. I usually do about a 3% annual increase in rents. I mean, if you've ever lived in an apartment, most people we have, and this year they're bumping my rent $15. They're, jumped the rent $20 this year. right? So that's that 3% annual increase. Expenses are the same though, too, right? Inflation, things get expensive. So property managers get more expensive, repairs get more expensive. So it's all rises together. So you want to factor those in as well. You don't want to just pad the rent and then not, do the same. I usually do about a 3% annual increase in rents and 2% in, inflation for expenses. So this gives you a nice little 1, 3, 5, 10, even a 30-year snapshot, right? I mean, nothing's going to be for sure, but it's a good, it's a good way to look at it. Here's your cash on cash return metric we talked about. Typically it's higher than the cap rate because again, you're going off your initial investment, or your return on your initial capital put into the deal. So, see, your cap rate's going to rise as you raise the rents. Sorry guys, little call. So, it's a nice little snapshot, and this also even plugs in some rentals. What is the market rent? Oh, here we go. What did I say? $850 to $1,000. Here's a 660 square foot multifamily, right? For $1,000, $1,095. Here's a bigger one, it's 3.2. It's not really comparable to what's in that apartment building, but 1,600. So there you go. On the low end, 975. Top end, 1,095. So, and they're relatively close. I usually on rentals, I go about 3 miles, and then on sales comps, you can go a little bit further, but this is a nice little tool to show what you're doing. You can pitch your deals, and depending on what metric you want to use to show, maybe it's maybe you're a little lower cap rate, it's a little aggressive. So you might want to use a cash on cash metric to say, hey, don't worry about the cap rate. The cash on cash is more important because that's your initial investment anyhow. So, this is a great tool that you need to know how to use, whether you're plugging and playing or you're just analyzing deals and knowing how you came up with this. But again, cap rate, COC, right? Cash on cash. Get familiar with those if you're not, because again, it is imperative you know how not only to arrive at that, but how you need to be able to explain that. Okay, because even some owners they don't know. They just buy it, and they don't know, and that could really hurt them. Getting into the deal, not knowing how to come up with this stuff. So, educate yourself and educate your clients, educate owners, because this is how banks are underwriting it, and this is how these assets are determined, value. So, that was just a good little underwriting training here today. Again, we'll go more in depth on the cash on cash, the IRR, internal rate of returns. Those aren't as, maybe, I don't want to say they're not as important, right? But they're maybe not as common terms that you will hear on every single deal, but they're definitely important to get familiar with and at least know what it is. So if you're getting a question asked, just have your hands up in there, like, So yeah, that's a great little training. We'll be doing another one on the other metrics, but if you want to learn those terms, just go to www.jpcapitalsolutions.com/glossary, and you'll have all the terms there. Or if you're an agent in our brokerage, you obviously have the terms in the agent portal there, and more resources for you to get this done. But yeah, download this, guys. It is in the agent portal, or you can download it there as well. So reach out if you got any other questions, guys, and thanks for being on.